Your Netflix bill went up in March.
Here's where that dollar went. On the 26th of March, the ad-supported plan went from $7.99 a month to $8.99. 5 days later, Netflix's quarter closed. Inside that closed quarter sat a $2.8 billion payment, gross, for a company Netflix decided not to buy. 3 weeks after that, Netflix told shareholders its cash flow projection for the year was going up. The reason it gave, in writing, was that payment. It didn't name the price rise, it didn't name subscriber growth. And in the 3 months after, Netflix bought back $4.7 billion of its own stock, the largest buyback quarter in its history. So the dollar left your account in March. Something much larger arrived at Netflix in the same window. Where did that money go? Here's what's strange about that sequence. The money Netflix made most loudly this year came from a deal it walked away from. The money you paid came from a price it raised on you. So when did the windfall land? Who ended up holding it? And what were you charged in the same breath? You have to remember what this used to be. One plan, everything on it. You paid once and you stopped thinking about it. It was the cheapest line on your statement and the one you'd have defended. You gave the password to your sister. Netflix knew, and for years, it didn't mind. That was the deal, and for most of a decade, Netflix kept it. And it kept it because it needed you more than it needed your dollar. Every new member was the product. The price was just the door. The number that mattered then was how many people came through it, and Netflix published that number every single year. Look at this line, 6 annual points, climbing. At the start of that stretch, 167 million paid memberships. By the last year Netflix reported it, just over 300 million. That is the growth story you lived through, and it was real. It was also a volume story. More people, month after month. And we know that for certain because in that final reported year, Netflix showed its work. Average paid memberships were up about 15%. Average revenue per membership was up about 1. 15 points of people, 1 point of price. Anyone with the filing could check the split, and the split said, they're growing because more of you are joining. That's the Netflix you remember paying. It grew by adding you. Then the line stops. 6 points, and the axis runs out. We'll come back to why, because it decides this entire argument. What replaced it is a different business with the same logo. It doesn't need to add you anymore. It needs to charge you more. Here's the explanation you've almost certainly read for why your bill keeps rising. Content costs are exploding. Prestige television is expensive. Somebody has to pay for it, and that somebody is you. That framing ran in the trade press the same week the prices changed. It's the story written about Netflix, not by Netflix. Netflix's own president, Greg Peters, puts it differently. His words on the most recent earnings call. We price behind that value that we are delivering. That's a value capture statement. It is not a cost recovery claim. Netflix has never actually told you the shows got more expensive. The press told you that. And against the filings, that story doesn't survive. Step 1. Watch the 2 lines on this chart. The first is revenue. The second is content amortization. The annual cost of the shows and films spread across the years they earn. Over the last 6 fiscal years, revenue grew 124%. Content amortization grew 78%. To be fair, Netflix never cut content spending. It spent about $9 billion in the first of those years and over $16 billion in the last. It just grew that spending slower than it grew your bill. And in one of those years, the ratio went the other way. That year is on this chart because leaving it off would be the cheat.
Two lines, both rising,
One much faster. On its own, that proves nothing. It's the ratio between them that does the work. Step 2. Now watch the same fact as a share. Content amortization started that stretch at 45.7% of revenue. It ended at 36.3%, a fall of more than 9 points. Over the identical years, operating margin went from 12.9% to 29.5%, up more than 16. Put those next to each other, and the story you were told inverts. The margin didn't expand because Netflix spent more on content. It expanded because content took a smaller slice of a bigger, repriced revenue line. The library got built in the 2010s. You're paying it off at a price that keeps going up. Step 3. Let's size what that's worth. Hold that opening ratio flat. Apply it to the most recent year's revenue, and content would have cost about $20.5 billion. It actually cost 16.4. The difference is roughly $4.2 billion of operating income in a single year that exists because the ratio fell. Against all of the operating income growth since the start of that stretch, that's about 39%. Nearly 2/5 of the profit growth is the ratio, not the shows. Step 4. Now put it in your units. Spread that $4.2 billion across the last membership count Netflix published, and it's about $14 a year per membership. Call it $1.17 a month. The ads tier price rise in March was $1 a month. That's an illustrative comparison, not an accounting identity. Different periods, different member bases, same unit. The point isn't that the two numbers cancel, it's that they're the same size. You weren't charged more because the shows cost more. You were charged more alongside a margin that was already widening without you. That's a pricing outcome being read as a cost outcome. On a bill, the two look identical. Step 5. The 5 days. Go back to March. Watch how tight this gets. On the 26th, your price changed. On the 31st, the quarter closed, and inside it, that $2.8 billion fee, gross. Netflix had bid for Warner Brothers, declined to raise its offer, and collected a break fee. Paramount Skydance paid it on Warner's behalf. Free cash flow that quarter was $5.1 billion against $2.7 billion the year before. Roughly a doubling in one quarter. Then in April, Netflix raised its full-year cash flow projection from about $11 billion to about $12.5, and told shareholders why in writing. The increase was due primarily to the after-tax impact of the Warner Brothers termination fee. The largest driver it names is a fee for a purchase it declined. Note where that fee sits, because it isn't in any of the margin numbers. It was booked below the operating line in interest and other income. Two separate taps, and we're never going to double count them. And that payment has a mirror image on somebody else's filing. Warner Brothers Discovery reported a $2.9 billion quarterly net loss. Its own filing says that loss includes the termination fee paid to Netflix. One number, two companies, opposite signs. Step 6. Netflix said the walkaway part out loud. Ted Sarandos describing the decision not to raise the bid. When the cost of this deal grew beyond the net value to our business and to our shareholders, we were willing to put emotion and ego aside and walk away. Take that at face value. The discipline was real. Walking away wasn't just prudent, it was paid. And the same letter describes what happened next. The buyback was paused during the Warner transaction. Netflix declined to raise its offer. The fee arrived. And then, in the company's words, we resumed our share repurchase program. Nothing there needs to be alleged. It's a sequence Netflix published itself. Which brings us back to the line that stopped. Everything I've shown you splits one way. How much of the growth is price, and how much is more people? There's exactly one metric that settles it, and you already watched it climb. The membership count. The last full year Netflix reported it, you could still do the arithmetic. 15 points of people, 1 point of price. Then Netflix stopped publishing it. Its most recent annual filing says it discontinued the reporting of membership numbers, focusing instead on revenue and operating margin. Those are the two metrics this mechanism makes look best. So look at that chart again. 6 points, climbing, and then the axis just runs out. That blank space isn't an absence, it's a removal. It stopped being published in the same window your price started moving. You can't audit this. That's not an accident of the data, it's a decision someone made. And the honest version of that cuts both ways. The most recent quarter argues against us. Operating margin fell, 34.1% to 33.4%. And Netflix says that reflects first-half content amortization phasing, with the price rise only partly in the quarter. That's the company's own explanation, on the record, and we're not going to pretend it doesn't exist. It's also the strongest case that this is ordinary operating leverage rather than anything sharper. A moat that 300 million people reapprove every month is a strange thing to call a trap. What the filings do establish is narrower, and it holds. The ratio fell. The margin rose with it. And the number that would let you audit the rest is gone. So follow the money out of that quarter. No inference here, just the ledger, with the dates attached. January to March, $1.3 billion of stock repurchased. April. The board authorizes another $25 billion for buybacks. April to June, $4.7 billion, the largest repurchase quarter Netflix has ever run. First half of the year total, about $6 billion returned to shareholders. Free cash flow over that same half, about $6.6 billion. That's 90% of first half free cash flow going to holders of the stock. The termination fee, gross, was $2.8 billion. That's a little under half the buyback. Netflix has never disclosed what it was worth after tax, so that's the only comparison the record supports. Paramount Skydance wrote the check. And in the United States, the ad-supported plan went up $1 a month. That's the ledger. Money in from a deal that didn't happen. Money out to shareholders. A price increase on people who were already there. All three of those lines fall inside the same 6 months. And notice what isn't on this ledger. Not one line went to the thing your price rise was supposedly for. Nobody at Netflix hid any of this. By July, the only visible trace of that windfall in Netflix's numbers is a larger tax bill. A tax bill is a receipt. Proof of income already received and settled later. The money is gone. The receipt is what's left. And the number we'd need to prove the last step is the number Netflix stopped publishing. We can show you that it stopped. We can't show you what it would have said. Which is the point. You were told your bill went up because the shows cost more. The filings say those shows have been getting proportionally cheaper for 6 years. And the biggest cash event of Netflix's year was a check for a deal it didn't do. Your dollar went to the buyback. Netflix's moat is intact. That was never the finding. The finding is what the moat converts into now and who is standing at the other end of it. So give me your read. Was walking away from Warner Brothers the best deal Netflix made all year? And the other half of this trade is its own story. What happened to the company that paid the fee is on screen now.